There was a lot of talk of bubbles just over the last week, bubbles in AI, bubbles in markets. You don't particularly like that term. It's not one you want to use yourself.
Yeah, I don't like to be, over dramatic.
The bubble in bubbles.
I've been looking at tech multiples and trying to put tech multiples in a historical context. I've looked at a variety of data on public company tech multiples and also private capital formation for tech companies, and it strikes me that that the multiples are kind of 75th percentile or 80th percentile. So there's no question, we're somewhere in a cycle where the values are higher, but the growth opportunity coming from AI is significant. But I'm certainly in the camp that there are going to be winners and losers. Capital's been allocated to companies that are going to be hugely important companies, and it's going to be allocated to companies that ultimately won't make it or won't succeed in that context. And ultimately, whenever we have a new technology, especially at scale, and you have significant capital formation around it, there are going to be winners or losers. We're not smart enough, to pick them all. And ultimately, there's a rebalancing. But I think the long-term trends around this technology, the opportunity for productivity gains for some great companies to be formed is really quite exciting.
How about how you're using it internally at Goldman Sachs? Because you've made a lot of comments in the past about how this can really do the work for investment bankers much faster.
Well, I think there are couple of base ways that we're using it. We're very focused on this. The first is we've always, since I started 40-some years ago, we get technology tools into the hands of really smart people to make them more productive. So I always joke about doing a common stock comparison 40 years ago. It took 6 hours. You had to go to the library, go get microfiche to get back issues of the Wall Street Journal. Now somebody can do it in seconds. It doesn't mean we don't have a lot of very smart young people doing a lot of work. They're just doing different work than they did when I started 40 years ago. And so we continue to get these tools into the hands of our very smart people, and it makes them more productive. It gives them an ability to spend more time with clients, to do more. It scales our footprint, our reach. The more interesting thing we're spending a lot of time on, you might have seen last week, Becky, that we put out a memo where we announced what we're calling One Goldman Sachs 3.0, the evolution of our One Goldman Sachs operating ethos, is we're really looking at 6 principles, throughout the firm to operate the firm more efficiently, serve clients better, where we're looking at processes inside the firm and saying this technology gives us the right and the ability for the first time to reimagine these processes and really do them entirely differently, to automate a bunch of things, to create meaningful efficiency that then can be reinvested in growth in the business. It's not just taking out cost, it's giving us more capacity to invest in our business and grow. And so we announced that because we're doing a lot of work internally. And, we said that in January we'll talk more specifically about how this can affect, the business. And, we wanted a framework to be able to really work inside the firm and really drive this forward. But I can't find a CEO that I'm talking to in any industry that is not focused on how they can reimagine and automate processes in their business to create operating efficiency and productivity. And that's a really good thing for economic growth.
Does that mean that this time is different and that it's not just going to make your employees more efficient, but it's going to reduce your headcount? Or
I don't think it's different. Technology has been having an impact on headcount, the way people work, what workers you have, for decades and decades and decades. And this, I think, one of the things that's happening here that's a little bit different is this is going at a pace that's quicker.
Yeah.
And so because the pace is so quick, I think there's a possibility that there's a little bit more volatility or, an unsettled transition, around certain job functions and things like that. But at the end of the day, we have an incredibly flexible, nimble economy. We have a great ability to adapt and adjust. And yes, there will be job functions that shift and change. If you go back 25 years ago, we didn't have 13,000 engineers at Goldman Sachs, and we've shifted and changed. My guess is the mix of engineers with this technology will again shift and change, but I'm excited about it. If you take a 3 to 5 year view, it's giving us more capacity to invest in our business. And I see lots of opportunities for our business, but I still feel some constraints because we've got to deliver returns as to how much we can invest to grow our business. And this should free up more capacity to do the things we want to do to serve our clients and grow our business. And that's exciting.